Welcome on board Karthik Lakshmanan, Karthikraj Lakshmanan, the Senior VP and Manager Equity at UTI AMC, joining in on the show right now. Karthik, hi, great to have you on ET Now. Thanks for your time. Karthik, we were just analyzing where will market find its next news trigger from, because everything is now behind us. All those overhangs which we were waiting for the market to actually move up are now history. Everything from the India-US trade deal to, for that matter, even earnings have all come and gone.
Yeah, true, Ishak. Clearly, in terms of macros we've discussed in the past, I mean, they're quite good. The trade deal is also behind, and overall, the Q3 earnings have been more or less in line with expectations, and we are seeing acceleration in earnings growth when we step into FY27. So broadly, the fundamentals look good. Valuations too, they've gone through some time correction. So not much to complain from a fundamental perspective, but in the last few days, clearly we've seen IT as a sector having headwinds, and we've seen a sharp correction there, and because of which the overall index also has had some impact.
That's the irony of it all, right? Because on paper, everything is looking okay. Earnings have been fine. Okay, IT is one standalone case. But other than that, all that positivity is not quite reflecting on the markets or the ticker. Do you think it will now all be led to the FII comeback?
I think flows is difficult to predict, and eventually, if the fundamentals are in place, if the earnings growth accelerates, whether it's domestic or FI, eventually the fundamentals should do the weightlifting, and the markets follow. There could always be lead lag, so it's difficult to say whether, I mean, how the flows will be, or whether it will be FIs who will contribute or domestics. But fundamentals, as long as they play out the way we are envisaging, things should be better. On the valuation front, while it has come down from expensive zones seen in September 24, it's still on a higher level compared to, say, probably few years back or the long-term average. And to that extent, there could still be stock specific, or it should be far more a bottom up market where valuations are commensurate with the growth that the companies or the sectors are offering.
How do then churn your portfolio and for returns in this such a scenario where you know there is certain uncertainty, geopolitical uncertainty. There is no momentum with respect to flows which is coming in. Earnings have been better in Q3 versus Q2, but the forward-looking earnings upgrades are not coming through.
Yeah, so more than upgrades, the way to think about it is FY25 and 26 have been single-digit earnings growth years. FY26, if we see the nominal GDP itself is in single digit because of the lower inflation. That problem is likely to get addressed in FY27. We are looking at inflation normalizing, GDP itself getting into double-digit growth, and even the earnings growth is likely to be in the double-digit compared to the single-digit that we've seen in the last 2 years. So even without the upgrades, there is likely to be higher growth in the next year. So that is something which is positive for the overall markets.
Okay, and Karthik, hi, morning. Are you seeing comfort in the valuations that we're seeing across caps in the market right now, given that we have been through a correction? The markets are not doing all that much. Do you believe the valuations look justified across sectors? Where are you seeing valuation comfort, and where do you think there is still some need for valuations to cool off further?
From a market cap perspective, clearly large caps look a little more attractive compared to mid and small. And from sector perspective, financials, especially the banks, the private banks are still in relatively attractive valuations compared to even pre-COVID levels for the kind of growth that they have and the long runway of growth that they have, and not much of asset quality issues. We are largely behind the rate cut cycle, and to that extent, the NIM impact may also be behind, and growth is actually picking up. So that is one pocket where still valuations are quite attractive given the growth. Second, again, IT is another sector where the valuations now, after the recent corrections, have come down to sub 20 levels on P's and pre-COVID level kind of valuations for many of the large companies. So that is a space where I think we believe there is clearly value. Other than that, I mean, it is across sectors, some pockets where we could find some valuation comfort. But these are two large ones where valuations are at least not too demanding.
Um, on the capital goods front, how do you look at that now? Do you think a revival which is coming in now in capital goods? Many of the companies have now started, showing order book growth in Q3. ABB came out with good numbers of order intakes yesterday. You had other L&T talking about how private sector contribution to the entire order book has now gone up in Q3 for them. Do you think the capital cycle for private sector is back, and hence the capital goods sector or companies in this sector are going to now come back into focus again?
Yeah, so capital goods have done very well post-COVID in the last 5, 6 years overall in terms of business, and that is more than reflected in the valuations. While we've had a few quarters of lull, clearly the government capex at least continues to be growing in line with GDP. So they're committed on the capex side. And from the private sector side, while there has been a pickup in the last few years, but it has not been adequate enough. So one would hope as the utilization rate increases, the private sector capex also picks up in a big way. Overall, we are looking at decent business revenue growth, but compared to that, the valuations are now quite expensive in many pockets. So that's where we'll have to be very selective when it comes to the capital goods space.
Interesting. Also, Karthik, in this market, is there, I mean, merit in diversifying and sort of investing as per asset classes or rather as per market cap? And, then what happens to the small and mid caps, which have been so beaten down all through last year? Is there a fair chance for them to make a comeback?
Yeah, I think without doubt, I mean, investing diversification is a must. I mean, there is no taking away the importance of diversification. Now, within equities, like you highlighted, the mid and small caps, while index level, the correction has not been much. Individual companies have seen sharp cuts from their 52-week highs or all-time highs. So there's been silent correction in many of those names. The way to look at it is wherever the valuations are now reasonable compared to the growth that they have is space to be presented. That's where on an overall basis, maybe mid and small cap still expensive, but some of them post the correction look attractive across sectors. There could be opportunities in the mid and small cap space. So one has to be selective as far as mid and small cap is concerned.
Okay. Karthik, what is your view on the entire consumption space? This time in quarter three, we've seen recovery coming in staples. Discretionary has not done all that bad either. QSR is starting to see some amount of green shoots. Overall consumption seems to be trying to find its footing once again. Your view on which pocket within the consumption space, and of course BPC, the kind of moves that we've seen from some of the listed players, which pocket could do well going ahead?
So, within the consumer staples, from a longer term perspective, clearly foods seems to be a higher growth category than the non-foods FMCG. And overall consumption, the discretionary space could have higher growth than the FMCG or staples. The valuations are expensive on both sides, whether it is FMCG or discretionary, but at least the growth prospects look a lot more attractive on the durables, retail, and discretionary space than the FMCG space. But within the FMCG, foods is a space where we believe structurally the growth can be a little higher than the rest of the category.
Karthik, how do you look at some of the consumption within the consumption sector, the auto companies or the passenger cars especially, and if I were to ask you about some of the EV plays as well?
So overall, auto clearly got a fillip after the GST cut, and PV especially again has done well in the monthly numbers in the last few months. The stock prices have probably factored that in quite fast. and these are cyclical companies. While the long-term potential of penetration-led growth remains, the valuation is something that one has to be bearing in mind while evaluating these companies. EV, again, the opportunity is, I mean, very limited for a pure play EV investment from India perspective, and EV is evolving, and as we've seen probably last year or so, it has kind of taken a backseat globally as well. It will eventually catch up. It is going to be more a gradual run. But when evaluating overall auto and PV, the view is that the runway for growth is quite good, and relative valuations compared to other sectors still reasonable. But we've seen a sharp move post the GST cuts, and to that extent, have to be a little more selective.
Are you looking at the IPOs that have come in this year? Because it's been very muted, subscription for many of them, and especially and also muted listing for many of them. What's going wrong in the IPOs which are coming? Are they fully valued and not leaving enough on the table for funds like you to look at it?
I think the pipeline is quite strong. Clearly, we've seen a lot of companies coming up for listing, and that trend is likely to continue going forward as well. Just that, I mean, it's again cyclical. When the markets are doing well, you have a lot of IPOs getting rushed through, while when the markets are in a sideways or a correction phase, you have some of these issues getting postponed. I think it is more part of that cycle rather than anything else. And the pipeline looks still strong.
Right. Okay, Karthik, great to have you today on the show. Thank you so much for your time.
Thank you.